it's under pressure now, particularly also it's facing the Fed. You can get, you don't get any yield from gold, but you can get 5.1% from U.S. government. To me, that's a giant sucking sound for all risk assets. And it's also this year, it's had to face the stock market has been very resilient. I mean, what's really pressured gold for a lot of the last 10 years is, okay, well, the stock market's been a better place to be. That's changed. But I think we're in a transition time now, Tom, depending on when we publish. But I think we're at that transition time is that everything is going down because the recession's starting. People are starting to believe it. The stock market's going down. You hit risk assets. Gold's in there, but it should come out ahead. And I think most astute investors are probably more looking to buy gold. But I do think gold is underpriced versus the stock market, and it's going to $3,000 an ounce.
In a recent statement, Mike McGlone, senior commodity strategist at Bloomberg Intelligence, made a compelling case for gold as a standout performer among industrial metals during economic downturns. McGlone's analysis suggests that with the looming recession and anticipated stock market decline, gold could reach an impressive $3,000 per ounce. Looking back to the financial crisis of 2007, McGlone noted that when the stock market collapsed, investment demand for gold surged dramatically. Over the subsequent 4 years, gold's value doubled, highlighting its resilience during turbulent economic times. McGlone emphasized that when you compare gold's performance to that of the stock market, it often shines during economic downturns and, in his view, currently appears undervalued compared to stocks. One factor supporting McGlone's outlook is the recent increase in gold purchases by central banks. The World Gold Council reported that central banks acquired 77 tons of gold in August, marking a substantial 38% rise compared to the previous month's purchases. Given the prevailing economic circumstances, this data adds weight to the argument that gold is a wise investment choice. Furthermore, McGlone's prediction hinges on the expectation that the Federal Reserve will cut interest rates more than the current market sentiment suggests. As Treasury yields retract from 16-year highs, the Fed's interest rate decisions will play a pivotal role in shaping the future of gold prices. Before diving into Mike McGlone's interview with Soar Financially, subscribe to our channel and give this video a big thumbs up.
Oh, yeah. Well, it's always the go-to. I mean, it's becoming the go-to in China, in India, and any place is a melting currency. And you can, gold has that cultural thing. But the key thing to remember, I think, about gold is it basically outshines virtually every commodity over time. Everyone. If you look at them over time, partly if you really have to store it. If you have to store crude oil, it's a toxic chemical. And the way you measure that is you can do futures. But I love overlaying and pointing out that trend. Almost all commodities. Now, it's maybe more closely correlated with copper, particularly versus the dollar, but it's a metal. I mean, you could drop it in the bottom of the ocean 1,000 years and come back and it's still there. Can't do that with any other commodity. Always forget that. And you never want to be long the price of a commodity you can grow in the long term. Mm-hmm. You want to be able to be a producer and sell that. Because why? You can grow petroleum in this country. 15% of our unleaded gas now comes from corn now, and that's going down. But the key thing about gold is right now is remember what it did in 2008? I was very long gold in treasuries because I was expecting that crash. That was one I got right, but way too early. Is it went from 1,000 to 700 before it went to 1,900. It goes down when people hit stops, which at the time we're talking is starting to happen. You sell what you can, but I think what's going to come out of this enduring deflationary recession, you have to get a pivot from the Fed. And just like it did from 2008 to 2011, I think gold's going to be one of the best performers. Now, it has been this year. It's still up 4%. Bloomberg Commodity Index is down 6%. Industrial metals are down 12%. That's a deflationary, recessionary leaning. But it's under pressure now, particularly also it's facing the Fed. You can get you don't get any yield from gold, but you can get 5.1% from U.S. government. To me, that's a giant sucking sound for all risk assets. And it's also this year, it's had to face the stock market has been very resilient. I mean, what's really pressured gold for a lot of the last 10 years is, okay, well, the stock market's been a better place to be. That's changed. But I think we're in a transition time now, Tom, depending on when we publish. But I think we're at that transition time is that everything is going down. Because the recession's starting, people are starting to believe it. The stock market's going down. You hit risk assets. Gold's in there, but it should come out ahead. And I think most astute investors are probably more looking to buy gold and sell risk assets like stocks and copper. One thing I enjoyed publishing recently, Tom, I don't know if I put it on LinkedIn or Twitter, but I will, is if you take the price of gold and in ounces, and overlay the S&P 500. It's basically been a cat and mouse game since when the U.S. came off the gold standard in 1971. Gold gets cheap, gold gets expensive versus the S&P 500. Right now, it's basically, as you mentioned, half the price of the S&P 500. I think they're going to meet at 3,000. It's not complicated, but typically what happens is when you go into U.S. recessions, if gold is cheaper than the S&P 500, it does very well. The last two. If it's more expensive than the S&P 500, it doesn't do well. It's half the price right now, enough said. So that to me is, and it's not going to be easy, particularly as you start tilting towards these things, and particularly when people start hitting their stops and realizing, oh man, I'm overweight along the equity market. Everybody is. If you've been in it for the last 10 years, it just makes you overweight and underweight gold. So that's the key thing I always look at. It's sometimes it's so best to use the KISS method, and that is one thing I've published recently. I'll put it again on LinkedIn and Twitter is just take gold with the S&P 500. And typically when it's this cheap, you probably better off long gold and short the S&P 500 when you go to recession. If you want to get a measure for the S&P 500, just measure with divide by GDP times 100 to get to the same level as the S&P 500. That's why I think we're both going. I think it all meets around 3,000.
The COVID-19 pandemic has ushered in a renewed appetite for the safety and security of gold, evident in the surge of gold ETF holdings during the first quarter of 2020. Gold-backed ETFs, often considered a proxy for investor sentiment, witnessed a staggering influx of funds, totaling a remarkable $298 trillion. This surge propelled global holdings in these gold products to a historic high, tallying up to $3,185 trillion. Mike McGlone, a seasoned voice in commodity strategy, emphasizes a pivotal point in this gold rush: gold's enduring ability to hold its value amidst economic turmoil. Moreover, the World Gold Council highlights a noteworthy trend in central bank behavior over the last 3 months. Central banks worldwide have collectively purchased 219 tons of gold during this period. McGlone proposes a compelling theory for this central bank gold rush, speculating that it might safeguard against the uncertainties looming on the economic and geopolitical horizons.
I've been dealing with gold for decades, and you have to be careful of the gold bugs, always looking for things and reason for it to go up. Mm-hmm. And I look at myself, the key thing I love about being in Bloomberg Intelligence, Thomas, I'm completely neutral. They're my views. And I don't have a tap on the shoulder from a manager saying, oh yeah, Mike, we're selling a gold product. You got to be bullish gold and you can't be bearish stocks. There's so much of that you're going to hear and see. It's my views. I get edited, and that's why you see me working with a little bit of editor. I'll do that after we speak. And my view is typically showing out the facts and the focus of gold. Here's one thing I want to point out about gold. The price this year at 1933. I love that price. It's such the significant year that marked the bottom for U.S. deflation in the recession, and because we just devalued the currency versus gold when FDR went off the gold standard. Or, I mean, I shouldn't say off the standard, but devalued the currency versus gold. Mm-hmm. The average price here is 1933. That's the highest priced annual price ever. Okay, it's pulling back a little bit. It's running around 1900 as we speak. That makes sense as we start to hit stops and everything other markets. But you can't say that. I'd like to any other major asset can say it's the highest price ever as we tilt towards recession. I don't think so. Now that's dollars. In yuan and yen, it's all-time highs. It's just that's what gold does. It's and no other commodity can really say that, and it's what it's supposed to do. And even versus cryptos, the crypto people don't like when I really point this out, but it's been enduring. I think it's going to continue. And there's certain times when the store value really has value, and that's we tilt towards global recessions, deflationary recessions. It's happening in Europe. China, I think, is just a matter of time, and U.S. is a matter of time. So we get a typical deflationary recession. We get a pivot from the Fed, a pivot from most central banks. Stock markets underperform. Just having the asset that doesn't go down, it's doing great. But I do think gold is underpriced versus the stock market, and it's going to $3,000 an ounce. And other currencies I don't know. But here's one key thing that's different. I'll end with this: is there has been significant outflows from investors this year, almost 10% from if you look at total holdings of ETFs in ounces, not dollars, because the dollars distort in ounces. That has basically never happened, Tom. And I think there's good reason for this divergence. Now, people are still having other places to go. They can clunk down their money with the U.S. Treasury and get 10% in 2 years. The stock market's been great. But what's been significant is the deepest pockets on the planet have been buying. You probably all know this, central banks. Does that stop? Probably not. Why? Because the war started. Remember, we have a war going on. And somewhat people call it what's been happening with the dollar. But weaponization. That's the word I was trying to grab there. It's don't fade the deep pockets. They can print money and buy gold. They are not buying silver that I know of, or copper, or stocks. So of course, the Bank of Japan still buys stocks, I think. So let's not digress too much. But that's the way I see it. And again, I'm neutral. I've only been bullish gold, and also I will point out if you compare gold's performance versus any other commodity, any other broad commodity, agriculture, everything, it outperforms over time.
In a reassuring development for the gold market, Christian Gopal, a senior analyst at the World Gold Council, has highlighted a significant shift in the dynamics of central bank gold purchases. Gopal's insights suggest that the market has successfully moved beyond the period of net selling observed in April and May. During that time, the primary driver of this trend was the substantial non-strategic selling activity originating from Turkey. What implications might this shift in central bank behavior have on the broader economic landscape, and how might it influence the future performance of gold as a strategic asset? Share your thoughts in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.